Three completely different things happened at almost the exact same time today. And if you only watched silver, you probably missed all of them. Bitcoin dropped below $60,000. A market fear gauge that most people have never even heard of spiked over 6% in a single session. And a brand new silver mining company that just went public on the New York Stock Exchange crashed 10% on its very first day of trading. Individually, these might look like three unrelated stories. Together, they're actually telling you something important about the environment silver is trading in right now. And almost nobody is connecting these dots for you. Today, I want to teach you about a genuinely useful concept called the fear index. Show you why Bitcoin crashing on the exact same day silver wobbled actually matters, and walk through why a brand new mining stock's disastrous debut might be one of the more honest signals about silver sentiment that you'll see all week. Let's get into it. This is OG Silver Stacker. Every video, a new lens to look through. Let's go. Let's start with something most casual investors have heard mentioned but never actually had explained properly. The Market Volatility Index, often nicknamed the Fear Index. Today, this index jumped by more than 6% in a single session, which is a meaningful move worth understanding. Here's the simple version of what this index actually measures. It's calculated based on options trading activity in the stock market, specifically looking at how much investors are willing to pay for options contracts that protect against big price swings. When investors are calm and confident, they don't feel the need to pay much for that kind of protection. And the index sits at a relatively low level. When investors get nervous and start scrambling to protect their portfolios against potential sharp drops, they bid up the price of those protective options contracts, and the index climbs. In other words, this index is essentially a real-time measurement of how scared professional investors collectively are about the near future, expressed as a single number that updates throughout the trading day. A 6% jump in a single session is a meaningful, though not yet extreme, increase in measured fear. For context, during genuinely severe market crises, the same index has historically spiked by 50, 80, even over 100% in the most extreme moments. Today's move is nowhere near that level of panic, but it does represent a clear, measurable uptick in nervousness across the broader investment community. And understanding why that matters for silver specifically requires connecting a few more dots. Here's the question worth asking directly. This fear index is technically built from stock market options data. So why should anyone holding silver, a completely different asset class, actually care about it? The answer connects directly to something we discussed in detail in a previous video. The mechanics of how cross-asset liquidity pressure works during periods of market stress. When this fear gauge climbs, it reflects a broader shift in investor psychology, not just narrow stock-specific concerns. Investors who get nervous about stocks often simultaneously reduce their overall risk exposure across their entire portfolio, not just within their equity holdings specifically. This frequently means reducing exposure to other assets perceived as carrying meaningful risk too. And during certain types of market stress, silver, despite its monetary characteristics, often gets bucketed into this broader risk asset category. Rather than being treated purely as a safe haven hedge the way gold sometimes is, this is actually a genuinely important nuance about silver's dual identity that we've touched on in earlier videos, but haven't fully explored from this specific angle. Because silver carries meaningful industrial demand exposure tied to economic growth and manufacturing activity, a broad-based spike in fear about future economic conditions can sometimes pressure silver similarly to how it pressures other growth-sensitive assets, rather than silver automatically benefiting from increased fear the way you might naively expect a safe haven precious metal to behave. This is exactly why watching this fear index gives you useful, real-time insight into which version of silver's identity, the safe haven version or the industrial risk asset version, is currently dominating market behavior on any given day. Now, let's talk about something that almost no traditional silver content ever properly addresses: the relationship between silver and Bitcoin. Today, Bitcoin dropped below $60,000, a psychologically significant round number level, falling alongside broader weakness across the cryptocurrency market more generally. Here's why I think this connection deserves genuine attention rather than dismissal as some unrelated coincidence. Over recent years, Bitcoin has increasingly been treated by a meaningful segment of institutional and retail investors as a kind of digital analog to precious metals, sometimes explicitly marketed and discussed as digital gold. Whether or not you personally buy into that framing, the practical market reality is that a growing number of large investors and trading algorithms treat Bitcoin and precious metals as belonging to a similar broad category. Alternative, non-traditional store of value assets, meaning capital sometimes flows in and out of both asset classes for similar underlying reasons, even though the actual fundamentals driving Bitcoin and silver are completely different in substance. When you see Bitcoin and silver both showing weakness on the same day, alongside a spiking fear index, that combination suggests The selling pressure is more likely connected to broad, macro-level risk reduction across alternative assets generally, rather than anything specific to silver's own supply and demand picture, or anything specific to Bitcoin's own technological or adoption story. This is genuinely useful diagnostic information. If silver fell sharply while Bitcoin and broader risk sentiment remained calm, that would suggest something silver-specific was driving the move. Seeing multiple fundamentally unrelated alternative assets move together on the same day points toward a broader, macro-driven liquidity story instead. Similar to the tech stock liquidation mechanism we explored in detail in an earlier video, just now extending into the cryptocurrency space as well. Let's move to something genuinely fresh that I think deserves its own dedicated discussion, because it happened just this week and connects directly to sentiment around silver specifically, rather than the broader macro risk story we just covered. A Mexican silver mining company made its debut on the New York Stock Exchange this week through an initial public offering, meaning the company sold shares to public investors for the first time. On its very first day of trading, the stock dropped roughly 10% from its offering price. Here's why this single data point is genuinely interesting and worth understanding properly. When a company goes public, the investment bankers managing that offering typically try to price the shares at a level they believe reflects genuine investor demand and appetite. Based on extensive conversations with potential institutional buyers in the weeks leading up to the actual public debut, a new stock dropping sharply on its very first trading day suggests that actual public market demand, once trading opened up to the broader investing public, came in considerably weaker than what the underwriters and the company itself had anticipated when setting that initial offering price. For a company specifically in the silver mining business, debuting during this particular stretch of choppy, uncertain silver price action, this kind of weak reception offers a genuinely honest, real-time signal about how the broader investment community is currently feeling about exposure to this sector. It's a different kind of signal than watching the spot price of silver itself move day to day, because it reflects a fresh, real money decision by a wide range of investors about whether they want new exposure to this specific industry right now, made completely independent of any existing position they might already be holding. A weak debut like this suggests that broader investor appetite for new silver mining exposure remains genuinely cautious right now, which is a meaningfully different signal than simply watching the spot price bounce around from one session to the next. Let's talk about something genuinely valuable here: how to actually synthesize multiple different types of signals into a coherent overall picture, rather than treating each one in isolation or getting overwhelmed by trying to track too many things at once. Think of these three signals we've discussed today: the fear index, the Bitcoin and broader alternative asset weakness, and the new mining stock's disappointing debut, as three different lenses looking at related but distinct aspects of the same broader situation. The fear index tells you about general market psychology and risk appetite across the financial system as a whole. The Bitcoin connection tells you whether silver's weakness is part of a broader, macro-driven alternative asset rotation or something more specific to silver itself. The mining stock debut tells you specifically about fresh investor appetite for silver sector exposure, independent of existing positions. When multiple, genuinely independent signals all point in a similar cautious direction simultaneously as they did today, that convergence carries more weight than any single signal would on its own. This doesn't mean panic is warranted, and it doesn't mean you should dramatically alter your long-term stacking strategy based on one day's combination of signals. But it does mean today's broader market environment deserves a bit more attention and caution than a day where silver simply moved on its own, in isolation, without these other corroborating signals appearing alongside it. I want to be genuinely balanced here, because it would be easy to take everything we've discussed today and spin it into a much scarier narrative than the actual data currently supports. Let's be honest about the limitations of what today's signals are actually telling us. A 6% move in the fear index, while meaningful, remains relatively modest in the broader context of how dramatically this measure can spike during genuine crisis periods. We're seeing elevated caution, not panic. Bitcoin dropping below a single round number psychological level doesn't necessarily indicate some kind of broader structural breakdown in cryptocurrency markets. Round numbers often act as short-term psychological battlegrounds that get tested and sometimes reclaimed within relatively short timeframes. And a single new mining stock's weak debut, while genuinely informative as one specific data point, represents one company's specific offering circumstances, valuation, and timing. Not necessarily a definitive verdict on the entire silver mining sector or silver itself. The honest, balanced takeaway from today's combination of signals is that we're in a period of elevated caution and uncertainty across multiple loosely related asset classes simultaneously. Not necessarily the beginning of some dramatic, accelerating crisis. Markets move through phases of heightened nervousness regularly, And most of these phases resolve without escalating into anything more severe. Today's signals are worth noting and monitoring, but they don't yet constitute a confirmed major warning that requires dramatically altering your long-term approach to stacking silver. Let's add some genuinely useful historical context here, because understanding how these fear index spikes have typically resolved in the past helps calibrate appropriate expectations for what might follow today's specific move. Historically, modest spikes in this particular volatility measure, in the range we saw today, have most commonly resolved within a relatively short window, days to a couple of weeks, either through a continuation of whatever specific concern triggered the spike resolving itself one way or another, or through the market simply adjusting and recalibrating its risk assessment as more information becomes available. Sustained, persistently elevated readings over much longer periods have historically been associated with more serious structural concerns, the kind that don't resolve quickly because they reflect genuine, unresolved uncertainty about major economic or geopolitical questions. Given everything we've discussed in recent videos about the still fragile, multi-stage nature of the broader geopolitical situation, the ongoing uncertainty about the Federal Reserve's actual rate path, and the broader questions about artificial intelligence spending that triggered the tech stock weakness we covered in an earlier video, there are genuine, unresolved sources of uncertainty currently sitting underneath today's elevated readings. This suggests today's spike isn't purely a random isolated blip, but it also doesn't yet rise to the level of the kind of sustained structural fear readings that have historically preceded the most severe market dislocations throughout financial history. Let's bring this back to something genuinely practical for those of you watching this who are primarily physical silver stackers, rather than active traders monitoring these signals minute by minute. First, recognize that days featuring this kind of multi-asset, cross-market nervousness often create exactly the kind of short-term price weakness that long-term stackers have historically used as buying opportunities. Precisely because the selling pressure is frequently driven by broad, macro-level caution, rather than any genuine deterioration in silver's specific long-term fundamentals. The structural deficit story, the industrial demand growth from electric vehicles, AI infrastructure, and power grid modernization, we've discussed extensively across previous videos. None of that has been touched by today's fear index spike or Bitcoin's move below $60,000. Second, use signals like the new mining stock's weak debut as useful sentiment context. But don't treat any single company's specific circumstances as a verdict on the entire silver investment thesis. Every individual mining company faces its own unique combination of valuation, timing, operational, and geographic factors that can influence how its shares perform, separate from broader sector-wide trends. Third, and this connects to something we discussed in an earlier video about checking your own emotional relationship with price volatility. Days featuring multiple simultaneous warning signals like today can amplify anxiety beyond what any single piece of news would normally produce on its own. Recognizing this amplification effect in your own emotional reaction helps you avoid overreacting to what might ultimately prove to be a relatively short-lived, modest bout of cross-market nervousness, rather than the beginning of something far more serious. Let's close out today's deep dive with something genuinely actionable. A simple framework for how you might think about tracking these kinds of cross-asset signals going forward. Without becoming obsessively glued to your screen checking dozens of indicators every single day, consider periodically checking, perhaps weekly rather than constantly, where this fear index sits relative to its recent range, simply to get a general sense of whether broader market nervousness is elevated, declining, or stable. You don't need to become an expert options trader to use this as a simple, useful gauge of general market mood. Consider occasionally glancing at how Bitcoin and the broader alternative asset space are behaving, specifically as a cross-check for whether any silver weakness you're seeing appears connected to broader macro liquidity pressures, similar to what we discussed today, or whether it looks more isolated and silver-specific, which would point you back toward the kinds of fundamental silver-specific factors we've covered extensively in earlier videos. And consider paying attention to how new offerings and capital-raising activity within the mining sector specifically are being received by the market, as an occasional honest gut check on real money sentiment toward the sector, separate from the day-to-day noise of spot price movements. None of these signals need to dominate your attention or your decision-making process, but having a basic awareness of where each one currently stands gives you a genuinely more complete three-dimensional picture of the environment your silver position is operating within, rather than fixating exclusively on the single number most people only ever look at, the spot price itself. So here's the real takeaway from today's Monday warning signals. Bitcoin dropping below $60,000, the fear index spiking over 6%, and a brand new silver mining stock stumbling badly on its public debut all happened within roughly the same window. And together, they paint a picture of broad, cross-asset caution rather than panic, connected to the same underlying uncertainties we've been tracking across recent videos. The Fed's rate path, the fragile geopolitical situation, and lingering questions about economic growth. None of this, individually, or even combined, represents confirmed evidence of some larger crisis unfolding. But it's genuinely useful context for understanding the environment silver is currently trading within. The structural fundamentals we've built this entire channel around, the supply deficit, the growing industrial demand, the central bank buying signals, remain completely untouched by any of today's specific developments. Today was about reading the broader weather pattern silver is currently moving through, not about anything fundamentally changing beneath the surface. If learning to read these broader cross-asset warning signals alongside silver's own price action is the kind of comprehensive analysis you want from this channel, hit that like button, subscribe so you catch the next breakdown, and tell me in the comments, do you watch indicators like the Fear Index or Bitcoin yourself? Or was this connection completely new information for you today? I read every comment, and I'll see you in the next one.